Welcome back to the conference. I'm here with Travis Schwab, CEO of Eventus Systems. I'm Joe Schifano, Global Head of Regulatory Affairs at Eventus Systems. And Travis, I'd like to talk to you today about something called Pancake Bunny.
Sounds delicious.
Talk about.
Right.
So last week there was an interesting news article about this protocol, DeFi protocol, which was exploited using some flash loans. There was a bug involved. The attacker used the exploit to mint extra coins and take home a profit of $45 million. And in doing that, the price of Bunny, some token, collapsed by nearly 100%. Now, interestingly, from a different viewpoint, last week I also read an article explaining how decentralized exchanges handle the volume and the volatility of the markets very well.
Right.
In comparison with some of the reported slowness and outages on the more centralized venues. So this kind of got me to thinking about financial innovation generally. So thinking about the history of financial innovation, some of it occurred by necessity to account for new risks. Some were motivated by profits. Some were the product of economic collapse and recovery, incentivized by laws and regulations. Crypto seems to be different. In my mind, let's put aside for a moment the theory that Bitcoin is fundamentally understood to be, among other things, a hedge on inflation. My question, Travis, is what innovations will have the biggest impact as today's financial institutions grapple with client demand for all things, for everything, digital assets?
Yeah, I don't know if it's different, to be honest with you, Joe. It might be different. I still think we're still very early on. And as far as the specific innovations, I think we haven't seen them yet. I think we've seen a ton of great innovative work and great projects and great energy, not literally, but a lot of great focus in this area, a lot of great development in this area. But as far as how it ultimately changes or modifies or disrupts the financial system, I don't know if we're there yet. So I think we're driving to the ballpark of a 9-inning game. We're not in the early innings. We're not even to the stadium yet. So I think that the cryptocurrency, I think we should put aside. That's going to come to its natural equilibrium. I think the DeFi space and blockchain space are absolutely interesting technologies that are going to have interesting ramifications for the traditional asset classes, but I don't know where that's going yet. So I think we're very early in, and things like Pancake Bunny are going to happen often until they don't, and you have that maturation process that we're in the middle of.
Yeah, and what was interesting about this article is how this occurred, right? There was some bug. And the bug had to do with how the protocol calculates the number of new tokens to be minted. And just thinking through my lifetime of dealing with various innovations in the marketplace, going from manual to electronic trading and that sort of thing, it got me thinking, what are the headwinds to adoption in this space, in the institutionalization of digital assets, currency, tokens, blockchain uses?
Right.
What are the headwinds?
Well, I think the story that we're talking about here, discussing, is a distillation of one of the headwinds, and that's just safety, right? Is you cannot. And I'll take Texas Teachers, who's manages tens of billions of dollars for educators, former educators here in Texas, in Austin. The investment committee can in no way make allocations into any of these tokens, asset classes, Pancake Bunny, whatever, with the thought that they could be exploited away through a small bug. There's no way you have the traditional institutional investors are going to be able to make those decisions based off the current structure. Now that's not saying we're not going to get there, but there are big headwinds just from a safety standpoint. And you saw Gensler last week talking about we're going to aggressively go after crypto type infractions. And so the regulators are going to start biting back too. As this asset class grows in size, or as these projects grow in size, you're going to have some regulatory pushback because they're focused on investor safety. And so I think until you have that safety. That's a huge headwind. And then just in general, talking about regulatory issues, until you have regulatory clarity across jurisdictions, this is really one of the true global asset classes that we've seen since maybe FX. Until you have real clarity there, you're probably not going to have a lot of adoption because, firms and capital markets and just, again, investors in general don't like lack of clarity. So I think those are pretty two strong headwinds that are going to push back against adoption for the near term, at least.
Yeah, I think there's the investment community, and then there's a whole series of intermediaries, right, that work in this space that are looking to understand where and how they fit in, what they need to do, what the regulations are going to be, what kind of investments to make in infrastructure, and that sort of thing. There's another interesting point from the Pancake Bunny story. I'll keep coming back to it. I'll just read this line. The attacker borrowed 2.3 million, BNB, or $704 million, and some others, for a total of $707 million worth of leverage to do this scheme. And that had me wondering, well, how will the intermediary space adopt to this sort of thing, and what challenges do they face? Typical agency models, broker dealers, the buy side, the custodians, the folks that are traditionally involved in the financial space. What kind of challenges do they face?
Well, I think you have kind of two different paths of adoption here, or approaches. You have the DeFi path, which is different from, let's call it the kind of the crypto exchange space, and they're not distinct, but they're different. And I think that adoption is moving in a way that is evolving as it relates to the demand for those products. And so the DeFi space is still tiny, even compared to the kind of on-exchange space. The on-exchange space is still, as it relates to an asset class, is still tiny, right? They're not even the size of the FANG stocks. And so I see, that intermediation happening on the crypto exchange space, because right now they're, kind of hyper vertically integrated. And so until you have some intermediation, some safety safeguards, whether it's, settlement, transactions, AML, KYC, prime brokerage, custody, all those pieces of the puzzle, which have been understood, and a lot of safeguards and safety rails have been put in place over now, centuries. You'll have that evolving much faster, I think, but still a lot of that safety needs to be put in for adoption. And then DeFi is a different animal. And I think, again, it will be hard for institutions to come into that space unless there are distinct safeguards in place, to protect not just the money manager, but especially the end investor.
Do the intermediaries, as we know them today, and obviously that's a very broad spectrum of people, does it change? Does it adopt? Do new ones come into place? Does it contract? How do you see that moving along?
Yeah, I think you're going to have winners and losers as this process unfolds. The traditional intermediaries have scale, and scale has a lot of benefits. And so I think as you see adoption from the newer entrants into the marketplace, there's going to be a lot of transactions in that space where, guys get taken out because they've built successful businesses. And then you have new entrants, into the marketplace that are going to adapt and maybe even buy traditional firms to continue their growth. And so my assumption is you'll have a mix with, again, the leaning on the traditional folks that have effectively bought their way into the space as compared to necessarily innovating, which happens, again, we've seen this movie, several times throughout the course of capital markets history. And this is, I don't know if this is really a different one.
Yeah, just to wrap up references to the article, and this line sort of had me doing a double take when I read it. The article wraps up explaining that the exploiter pocketed this money, $45 million, and the money is known to be sitting mostly at an Ethereum address. And I was kind of scratching my head. I'm like, wow, this is in plain sight, right. And we can't reverse it. We can't stop it. And that got me to thinking, well, what assumptions in this space that we all have in how traditional venues work, markets work, what assumptions will be sorely tested?
Well, I think you hit on it, right? Is the fact that you have really interesting and unique transparency into this marketplace that we really haven't had in other asset classes, right? I mean, it's ironic the level of transparency that you have in this, whether it's blockchain or these tokens, but still the fact that you can't get to it is problematic. And so I think, again, whether that intermediation happens and where it happens are going to then command our assumptions, right? And influence how we think about this asset class. And so it's still a little early to decide what assumptions are going to be tested. But I think, there's going to be some really interesting evolution there.
Yeah, as I go around talking to people, one that continuously comes up is this idea of understanding who your counterparty is and who your counterparty's counterparty is, especially since we're talking about a global ecosystem, so to speak, in this space. And that has people thinking about, do I know who I'm trading with? And I think more importantly, will some regulator a few years from now ask me, did you know who you were trading with?
Right.
And that becomes an interesting sort of question. So you brought up capital markets history a few seconds ago, and I like to think I'm a little bit of a student of history, and I did some digging, so to speak, and I was pondering this question, who the winners and losers are going to be, and I was looking at prior sort of financial innovations and moments in time, and I was staring at the gold rush a little bit, and I was looking at some news articles about everyone going west and figuring out all these new players in that market, right? Trying to figure out where's my pot of gold. And I came up with this little quote. It's kind of hokey, but it was sort of interesting as it relates to who the winners and losers are going to be. The quote is it's from a news article back in 1848. It's not the digger who will finally remain the possessor of the spoil, but the man of capital taking advantage of others' necessities will, as in all other like cases, be the great gainer. It got me thinking, there's a lot of folks in here doing pretty well, and we got this concept of holding on for dear life and that sort of thing. So my question to you, Travis, is the crypto space the same game with new players, or is it a new game with new players, or a new game that the traditional players will learn?
So I think there is going to be some combination, Joe, of winners and losers there. And I think, again, we've talked about that kind of common thread. Have we seen this before? Obviously, they've saw it in Manchester during the gold rush. I think we've seen it throughout the course of history. There's always, some interesting innovations, and we're seeing really an interesting period in time. My assumption is there's going to be a really interesting mix of new players coming into that we're seeing today that are doing really cool things, and then a mix of old folks coming in there and adapting. So look forward to watching it unfold as we're taking part of it. Well, thank you, Travis, for this conversation. Thank you, Joe. Thank you to the Crypto Connection. And I hope everyone has a great day, and we turn it back to you.